when there is more money in an economy. Monetary inflation can be like having more money circulating in the economy. When there's more money, it can lead to an increase in property values. Here's two examples. Example 1, the candy store analogy. Imagine you're in a small town where there's only one candy store. People in the town have some money, and they like to buy candy. Let's say there are 100 pieces of candy in the store, and each costs K1. People in the town have a total of K100. Now, suppose the government decides to print more money and gives each person an extra K1. Now, there's a total of K200 in the town, but still the same 100 pieces of candy. People have more money to spend, but the candy supply hasn't increased. As a result, since more people have more money and still want candy, they might be willing to pay more than K1 for a piece of candy. The candy store owner realizes this and raises the price to K2 per piece. This is like inflation, the candy now costs more because there's more money in circulation. In the same way, property prices can go up when there's more money in the economy because people are willing to pay more for homes. Example 2, home price increase. Let's say for example you live in Kokopo, where houses are typically priced around K300,000. Over the years, the government prints more money, and people get salary increases, which means they have more money to spend. With more money in their pockets, more people want to buy houses in your neighborhood. However, the number of houses available stays the same. So, when multiple people want to buy the same house, they might start offering more money for it. For instance, someone might be willing to pay K350,000 for a house that used to cost K300,000 because they have more money and really want that house. As more buyers compete, prices go up, and soon, houses in your neighborhood are selling for K400,000 or even more. This is driven by the extra money in people's wallets, which is a form of monetary inflation. When there's more money in the economy, people often have more to spend, and they may be willing to pay higher prices for goods and assets like houses. This increased demand can drive up property values, making homes more expensive. Now the Bank of Papua New Guinea tries to control the supply of money in PNG to maintain economic stability and control inflation. By regulating the money supply, the central bank can influence interest rates, manage inflation, and promote sustainable economic growth. Inflation control. If there's too much money circulating in the economy, it can lead to higher demand for goods and services. This increased demand can push up prices, causing inflation. By controlling the money supply, BPNG aims to keep inflation within a target range to protect the purchasing power of the currency.